Hello and welcome back to Readings in Impact Investing. My name is Daniel Rosehill. This is a YouTube channel and a podcast that I set up in order to record readings in impact investing, as the name suggests. This is the ITF State of Play Report 2023. It was released at the month I'm recording this, which is December of 2023. And very, very important update from the ITF on how everything has evolved in the 2 years since their initiation as a task force. Of course, the world has also gone through some pretty dramatic changes in the same period. And this is it. So I'm going to be reading today chapter 3, which is their progress update on capital mobilization for a just transition. And just as a quick reminder, if you are enjoying these readings, whether you're listening to them at the gym, on your commute, or however else you like to listen to your podcasts, do please consider throwing around the link to anyone else who's involved in impact investing in your company, investment fund, or whatever and wherever you work. It's an initiative I'm doing purely to spread this important material. I don't work for either the ITF or the GSG, and it's a private and personal initiative. All right, let's go then with this chapter 3. The ITF workstream on capital mobilization was chaired by Dame Elizabeth Corley and led by the Impact Investing Institute. It convened 170 finance, policy and thought leaders representing 110 institutions in 38 countries between August and November 2021 and issued the report Mobilizing Institutional Capital Towards the SDGs and Just Transition. The 2023 Progress Update section has benefited from the expert inputs of our knowledge partner organisations, which can be found listed in Annex B. Notably, Convergence's input paper provides a recent snapshot and looks at the opportunities afforded by blended finance for closing the tremendous climate and SDG financing gaps that lay before us. The Blended Finance Taskforce, hosted by Systemic, looks at the untapped potential of guarantees, which have the potential to unlock $2.4 trillion annually for climate action. The CFF's input paper outlines a set of thoughtful suggestions for how to mobilize capital for small and growing businesses. Building on its legacy work for the ITF, the Impact Investment Institute is continuing to focus on growing the value of assets incorporating a just transition lens and has put our key practical tools for investors, including just transition finance criteria, a handbook for engaging communities in place-based impact investing, and Bridging Divides, a guide on using catalytic capital for a just transition. Finally, GSG's input paper looks deeper at many of the most critical capital mobilization topics we examine in this report: just transition financing, MDB and DFI reform, and encouraging greater engagement from domestic and catalytic capital providers and ways our network can support these initiatives. Our message in 2021. In 2021, we focused on how to deploy more institutional capital into global markets with the highest impact and growth opportunities, which entailed both destination and volume challenges. At the request of the G7 presidency to prioritize mobilization into EMDEs, we identified the key barriers facing institutional investors and called on the G7 to help break these barriers down. EMDEs is an acronym for Emerging Markets and Developing Economies. We outlined actionable pathways supported by concrete examples to enable each key stakeholder group, G7 policymakers, asset owners, asset managers, and intermediaries to effectively mobilize more impact capital. The pathways included repurposing familiar models of public-private collaboration for greater impact and reforming the mandates and operating practices of key national and multilateral DFIs to explicitly empower them to prioritize private capital mobilization, especially in EMDEs. We supported the call to promote the wider application of existing tools such as blended finance vehicle structures, insurance products, and portfolio-level guarantees to adjust the risk perception profile of investment opportunities for mainstream institutional investors in the near term. We gave examples of best practices that demonstrate what is possible today so that we do not unnecessarily reinvent the wheel when tried and trusted instruments exist. Given the primacy and momentum of climate funding, we were early advocates for the importance of social investment and the need to convert rhetoric around a just transition into a well-defined framework to mobilize public, private, and philanthropic investment to address the needs of those most affected. We made it clear that the framework had to integrate social and environmental goals to ensure public and places were not left behind in the transition to net zero, and we demonstrated how climate-led strategies can effectively incorporate socially inclusive objectives. Stocktake of progress. The numbers are going the wrong way. The SDG and climate funding gaps have widened since our last report. The macroeconomic and geopolitical environment that shapes investor appetite for risk has clearly deteriorated since 2021. Climate financing flows are running at around $630 billion a year, nowhere near the assessed need of around $5.9 trillion per year by 2030. Only 13% of climate funding is flowing to EMDEs, emerging markets, developing economies, where it is most needed. Adaptation finance currently represents only 7% of climate finance, and private sector flows are negligible. The annual financing gap for the SDGs continues to be estimated at around $4 trillion per annum. Against this backdrop of need, private finance to EMDEs, excluding China, is reported to have declined by 21% since the COVID-19 pandemic. EMDE saw net capital outflows of $522 billion in 2022. The situation improved somewhat this year, and mid-year data for 2023 reported much lower net capital outflows of $173 billion US. Nevertheless, capital is still not flowing at the speed and volume needed. DFI mobilization rates are still underwhelming. According to the OECD, total private sector finance mobilized by DFIs in 2021 amounted to just $40.3 billion, of which only 10% reached low-income countries. The private capital mobilization ratio of international financial institutions, or IFIs, is estimated to range between 0.1 to 1.5 times, with the G20 calling for mobilization ratios of at least 1 time. One of our core recommendations was for DFIs to structure more blended finance transactions in light of data from our knowledge partner Convergence, which reports that blended finance has mobilized $188 billion since 2014. Despite our recommendations, the numbers are going in the wrong direction. Total deal volume decreased by approximately 45% in 2022, while climate blended finance fell by about 55%, reaching a 10-year low in total financing. Moreover, climate blended finance transactions accounted for under 40% of all blended finance deals in 2022, while in each of the previous 5 years, climate-focused transactions accounted for 50% or more of the annual deal count. We called for a smarter and more efficient use of public capital, including leveraging de-risking instruments like guarantees. These instruments, with an average mobilization ratio 5 times higher than debt, can help to lower the cost of capital, as evidenced by research from the Blended Finance Taskforce. However, their most recent research shows that guarantees represent just 4% of total commitments. DFIs and MDBs are still not reaching their full potential as arguably the most critical drivers in transforming the supply of suitable opportunities to invest for impact on the SDGs and EMDEs. There is evidence of growing institutional investor appetite for impact-linked investment, although flows to EMDEs are inhibited. As we noted in our 2021 report, there has been a structural shift towards investment products that prioritize environmental and social responsibility on a spectrum of ambition. The ESG movement faces political challenges in the USA, but it has yet to be determined whether this has threatened the structural shift. In this context, it is worth noting that EU lawmakers recently adopted new sustainability reporting requirements that are expected to lead to around 50,000 companies reporting on the impact of their operations on the environment. ESG assets under management reached an estimated $35 trillion in 2022 and grew by 15% annually. This movement has greatly influenced corporate and investor perspectives on sustainability. Rightfully, the market is under increasing scrutiny from regulators who want to safeguard investors from greenwashing. We advocate for a response that acknowledges that doing less harm is no longer good enough. Our primary interest is in the growing spectrum of investors seeking opportunities to make measurable and intentional impact investment at scale. The Global Impact Investing Network, or GIN, estimates that the global impact investing market reached $1.16 trillion in 2022. The continued growth of the green, social, sustainability and sustainability linked bond market, that's GSSS bonds, which reached 4 trillion in 2023, is another significant development. Although this is encouraging, there is still room for improvement in terms of increasing issuance from EMDEs. The GSG has published a valuable report that outlines the key trends in this market's development and provides recommendations on how different stakeholders can foster greater adoption in EMDEs. In addition to the broad market shift towards ESG, the last few years have seen bold commitments to climate finance and net zero from coalitions of institutional investors, most notably GFANZ. However, it is clear that these institutional investors struggle to reconcile investments in EMDEs within their prudent regulatory frameworks, and very few have the flexibility to adjust their risk and capital change frameworks. And there's an example here that I'm going to read through. It's a sovereign sustainability linked bond, or SLB, in Uruguay. This is included, I guess, to demonstrate how SLBs work, or a successful working example. In 2022, the Republic of Uruguay issued a $1.5 billion sovereign SLB, that's sustainability linked bond, to finance its green transition. The bond's interest rate depended upon the country's reaching 2 specific performance targets, SBTs, linked to qualitative goals set for 2025 in Uruguay's national determined contributions to the Paris Agreement. The adjustment will be triggered by performance against 2 indicators: the reduction in GHG emissions by unit of GDP and the preservation of national forests measured in hectares. 2 SBTs are set against one another. Uruguay will face a step-up coupon if it fails to meet the minimum target, and be offered a step-down coupon if it manages to achieve an outperformance target. To assess performance, Uruguay will report GHG emissions on an annual basis and conduct satellite imaging mapping of forests every 4 years. UNDP will provide an independent external verification. The bond was 2.6 times oversubscribed and attracted 188 investors, of whom 21% were new to Uruguay's bond market, and enabled Uruguayan sovereign debt to achieve an historically high credit rating of BBB+, and that data is from the IDB in 2022. Geopolitical shifts have triggered increased pressure for change. We argue that achieving the necessary scale of mobilization would demand an extraordinary level of cooperative engagement, not only from market actors but also from governments. Since then, we have seen a substantive shift in geopolitics as outlined in the introduction to this update. In addition to structural shifts of economic power and growing awareness of the impact of climate change on the global economy, we have experienced a series of interconnected shocks, including conflict, energy market turbulence, and macroeconomic shifts, including higher inflation and interest rates. This has exacerbated the challenge of effective collaboration. However, one very clear shift is a growing influence and voice of the Global South, reflected clearly by the Bridgetown Initiative and at the following summits: COP27, the Summit for a New Global Financing Pact; G20 New Delhi Summit, in which the African Union joined as a permanent member; and the Africa Climate Summit. The pressure to change the way the financial system works for EMDEs has grown. Our colleagues and knowledge partners at the Blended Finance Taskforce have produced a useful overview of the reform agenda under active discussion. This figure is called Figure 2, Overview of International Climate Finance and MDB Reform Agendas, including the main levers, the enabling levers, and the primary focus. I'm not going to read through it as it's a table, but it is available on page 25 of the report. There is more visible support for the just transition. In 2021, we were among the first to argue for a more comprehensive definition of a just transition that incorporated social and environmental objectives into investment frameworks. Hence, we welcomed the emphasis that the G20 Sustainable Finance Working Group put on the need to avoid or mitigate negative social impacts in their development of a framework for transition finance. Our call coincided with the launch of Just Transition initiatives such as the G7-led series of Just Energy Transition Partnership or JETP packages in South Africa, Vietnam, Indonesia and Senegal. These country packages aim to link national infrastructure developed and decarbonisation plans with public and private financing. The success of the JETPs hinges on delivering the promise to facilitate socially just outcomes, meaning that JETP countries and their institutions will need to take on a leadership role. Sufficient investments in meaningful community engagement, worker upskilling, community rehabilitation, and other critical actions are essential to ensuring that no one is left behind in this complex and seismic economic transition. Mobilization of private capital is critical to JETP success, but it is hard to identify a country platform that has a clear implementation strategy or roadmap to achieve this. It is also not yet clear how the social and community voice component we advocated for as part of the Just Transition investment framework is being prioritised. In the private sector, multiple initiatives have been calling for stronger pipeline development and wider availability of de-risking instruments. These include the Glasgow Financial Alliance for Net Zero, Sustainable Markets Initiative, Investors Leadership Network, Blended Finance Taskforce, IAF, and Capital Mobilization Accelerator. There is a clear commitment to inclusivity, with GFANs, for example, building networks in Africa, Asia Pacific, and Latin America, as well as collaborating with JETP countries and country platform pilots. However, there is little evidence of the difference these initiatives are making to the flow of finance into EMDEs, nor of any clear prioritization of investment support for the social objectives that underpin a meaningful community-supported just transition. Drawing on their experience from heading up the mobilization workstream for our original report, the Impact Investing Institute turned insight into action by launching the Just Transition Finance Challenge, which brought together over 23 global institutions with more than $5 trillion of AUM committed to financing a just transition in both developed markets and EMDEs. Challenge participants collaborated to devise a set of just transition criteria to guide fund managers in designing and structuring investment products that demonstrably advance the key tenets of a just transition. A renewed call to action. In the near term, finance for the global energy transition will be the primary driver of private capital mobilization in the EMDEs. We maintain our stance that commitment to a just transition is critical for sustaining political support. Words need to be underpinned by tangible investment flows to support communities most vulnerable to job losses and the physical risks of climate change. We welcome evidence of renewed political commitment to support the mobilization of public and private investment in global markets, which will have a positive impact on the broad SDGs and climate goals. The challenge, as ever, is turning rhetoric into real-world flow of investment into the markets that need it most. For example, in the context of climate finance, the Blended Finance Taskforce analysis estimates that over 75% of climate finance pledges are not deployed. We must strive to understand why there has been so little progress despite extensive analysis of barriers and solutions. As the climate crisis deepens, inequality widens, and a shift in geopolitics brings increased pressure for change, not to mention societal pressures that are challenging the status quo. There is no doubt that 2024 needs to bring about pivotal change. Failure to respond adequately poses a systemic threat to our prevailing capitalist system and the liberal democracies that depend upon it. Political and business leaders' interests are aligned, and they must find a more effective model of collaboration. The way forward must revisit incentives and challenge current practices in public, private, and philanthropic sectors. Fragmented efforts are inefficient. The next cycle of leadership in the G7 and G20 needs to align key public and private actors behind a single transparent plan to mobilise private capital for impact on the SDGs in EMDEs with the level of accountability that will incentivise delivery. We recommend that this plan focuses on the most impactful and actionable levers of systemic change without neglecting the need to address two key long-term systemic issues. National governments and multilateral institutions must be more effective in identifying models of collaboration that can mitigate the real risk of investing in EMDEs through the implementation of micro and macroeconomic policies that foster more stable, supportive environments for private investment. Investment institutions must reassess their risk tolerance and perceptions of fiduciary duty in a world where business as usual is untenable and exacerbates systemic risks. In this process, they need to be mindful that a new generation of consumers and talents are likely to have different values, expectations, and demands. Within this process, long-term prudential regulators should be challenged as to whether their frameworks are too onerous with respect to the treatment of private assets from EMDEs. Ratings agencies should also be challenged as to whether their models adequately capture risk of EMDEs, especially in sub-investment grade countries. These systemic long-term issues need to be resolved but will not generate the short-term results we need. Given the need to pivot in 2024, we decided to prioritise finding a better answer to the critical question: how do we realise the full potential of the DFIs and the MDBs to mobilise institutional investment for positive impact on the SDGs in EMDEs? Just as a reminder, DFIs are Development Finance Institution and MDBs are multilateral development banks. It is now widely understood that the publicly owned international financial system is critical to mobilising private capital to where it can have the biggest social and environmental impact. Realising this full potential becomes even more important given the likelihood that MDBs will have more money to invest. The G20 review of MDB capital adequacy frameworks shows a path to taking more risk with existing capital without jeopardising AAA status, and shareholders are becoming more innovative in using guarantees to help unlock additional investment. The clamour for reform has grown, but with public resources and bandwidth both limited, so has the need to focus on what is most actionable and impactful. Since the original report in 2021, our thinking has evolved through discussions with DFIs, MDBs, investors in our RTF network, and colleagues across the GSG network. Our updated recommendations. Firstly, for government donors/shareholders. Coordinated action to clarify the mandates of DFIs. We reiterate our view that shareholders should review DFIs and MDBs mandates to ensure the correct messages are being conveyed. A more sophisticated approach is required than simply increasing mobilization ratios, which might push DFIs towards less complex deals and subsidies for commercial investors in middle-income countries, where they are not as needed. DFIs are often tasked with pursuing multiple and sometimes conflicting objectives. Increased investment in low-income countries, for example, involves a set of interventions and financial instruments distinct from those used for mobilizing capital for commercial investors, where the focus is on larger deals, mostly in middle-income countries with stronger credit ratings. However, by segmenting strategy along maturity and risk curves, the areas in which donors expect DFIs to be most effective in mobilizing private capital and recycling their balance sheet can be more clearly defined. Some mandates, for example those that are climate or non-climate related, may need to be segmented and prioritised, while others may require a review of their regulatory regimes in terms of the MDB's ability to co-invest with regulated entities, specifically commercial banks, for example. Ultimately, each MDB or DFI needs to be accountable for having a transparent mobilization strategy with clear metrics, appropriate safeguards, and clarity about which balance sheet components correspond to different priorities. Furthermore, the ecosystem as a whole should be incentivized to collaborate more closely at the institutional, national, and regional level, with DFIs and MDBs being held accountable for their collective impact. Both these elements are captured in the Paris Summit roadmap, and we take note of the commitment to a stocktake in September of 2024. Second recommendation, prioritise interventions that facilitate investment flow, especially risk perception adjustments. A. Promote a better understanding of real risk in emerging markets. One practical action is to accelerate the process underway to publish the GEMS Risk Database Consortium through an independent organisation with a more agile government structure. This would expedite the process of making this database, which contains a historic data of DFI deals, a public good accessible to third parties such as credit rating agencies and regulators, who will then be able to base risk assessments and rating evaluations on real rather than perceived levels of risk. Recommendation B, find a better solution to hedging FX risk in SDG-aligned projects. The Bridgetown Initiative has quite rightly focused on the need to find a better solution to the substantial problem of hedging FX risk in SDG-aligned projects, which has a critical bearing on the cost of capital in EMDEs. When considering this issue, it is important to bear in mind the fundamental need to address the macroeconomic factors that underpin FX risks in terms of volatility and the trend towards depreciation. To identify the correct interventions for managing existing risk and enabling investment flow, we need to distinguish between large investment-grade countries that have access to FX derivatives and smaller sub-investment-grade countries that don't. There has been discussion surrounding a pragmatic option to scale up and diversify the existing Currency Exchange Fund, TCX, which was set up in 2007 by DFIs, donors and microfinance investment vehicles to act as a market maker for currencies and maturities not covered by the markets. While there may be good argument for this, decision makers would need to be clear on how to reduce and cover costs, ensuring the financial burden is not borne by those least able to afford it. Solutions that do not involve a significant element of subsidy or first loss provision are hard to come by, and our premise is that all subsidies should be prioritised for the markets that most need them. We would also like to flag a recurring issue, namely the pressing need to create more opportunities to deploy large, fast-growing pools of domestic capital in certain EMDEs to generate impact in the real economy. The debate surrounding this topic understandably focuses on breaking down barriers to the flow of international capital, but we believe in giving greater prominence to supporting domestic capital markets through flows of domestic capital that do not involve FX risk hedging that could lead to a more stable commitment to investment in the real economy of their countries. Recommendation C increases supply of catalytic tools for EMDEs. It is time to recognise that in the short to medium term, risk mitigation and credit enhancement are required as a means to the end of helping institutional investors recognise private EMDEs' risk with their risk and capital change frameworks. In time, the degree of risk mitigation required should taper with better data to support decision making. Catalytic capital is therefore critical to unlocking impact and drawing in additional investment that would not otherwise be possible. Here we use its broadest definition, encompassing the full toolbox of catalytic capital: subsidies, guarantees, blended finance structures, concessional capital, insurance contracts, and outcome payments. Catalytic capital can come from different sources, including governments, philanthropists, corporates, family offices, and insurance companies. The common goal is to change market dynamics and, in the case of concessional capital, to transform the investability of high-impact projects. The last decade has brought new and welcome philanthropic interventions like the Catalytic Capital Consortium, C3, and the Global Energy Alliance for People and Planet. We have seen public development institutions like British International Investment, BII, Development Finance Corporation, DFC, the World Bank, and Private Infrastructure Development Group, PIDG, innovate and demonstrate what is possible. For example, the World Bank has led the way in designing subsidy programs that has transformed the ability of private companies to offer affordable distributed energy solutions to help reduce energy poverty in sub-Saharan Africa. In national context, we have seen governments creatively deploy catalytic capital to build markets. For example, the social impact investment market in the UK is now worth over 9 billion UK pounds, with growth largely attributable to the creation of a new catalytic wholesale fund in 2012, which was called and is Big Society Capital, or BSC. If we are to unlock more private capital for impact in the 90% of EMDEs that don't have investment grade status, then we need more catalytic capital, and we need to make sure that this precious resource is used in the smartest possible way, targeting the greatest impact and need. Next recommendation, more catalytic capital available for EMDEs, new pooled facilities from existing budgets. We believe that it is time to structure new catalytic capital facilities that would ideally pool top-sliced resources from existing public budgets controlled by high-income countries. Included in the sources are Official Development Assistance, or ODA, climate finance, multilateral funds such as Green Climate Fund, Global Energy Environmental Facility, Climate Investment Fund, and initiatives like the G7-led Partnership for Global Infrastructure. This was originally proposed by our knowledge partner Convergence in their groundbreaking Action Plan for Climate and SDG Investment Mobilization, produced in partnership with USAID. The action plan estimates the catalytic capital of $13.5 billion plus a catalytic grant of $2.5 billion, combined with $45 billion of mezzanine finance from DFIs and MDBs, could collectively mobilize $286 billion of private investment annually, which would represent 6 times the current mobilization of the entire development finance system. Since the current fragmented approach has failed to deliver, the time has come to try something different. We encourage new facilities to be set up regionally with a mandate to provide supporting nationally and regionally led blueprints for mobilising different types of domestic and international capital in order to invest for high impact in priority areas like facilitating access to appropriate capital for job creating micro, small and medium sized enterprises. That acronym is MSMEs. Tap new sources of catalytic capital. We would take this a step further to encourage coordinated engagement with new sources of catalytic capital. The insurance industry should be viewed as a priority, considering the financial implications of the climate crisis for the industry. Given their current very low level investment, there are certainly opportunities for the industry to invest more of their portfolio in low carbon and climate resilient infrastructures in EMDEs. However, beyond this, the insurance industry already has the tools as well as the ability to create new ones to support cost-effective risk mitigation in partnership with development banks and donors. We also note with interest the arguments being made for the strategic value of the largest sovereign wealth funds being seen to support this critical mobilization, especially if they have generated windfall profits from recent turbulence in the energy markets. Although increasing the supply of catalytic capital available to EMDEs is necessary, this alone is not sufficient. There must also be a much greater commitment to smart collaboration between DFI, MDBs, private and philanthropic sectors and national governments who have their own catalytic toolbox for unlocking private investment for impact. One dividend of this collaboration, as we go on to explore, must be a greater shared understanding of what works in terms of deploying catalytic capital effectively in different contexts. Enable the greater use of guarantees. In 2021, we called for greater use of guarantees in light of growing evidence of their relative impact and cost effectiveness. Since then, further analysis from Systemic, represented on our steering committee, has strengthened the case. The report gives examples of effective guarantees, products that could be scaled, including Garanco, SIDA, and US International DFC's partial credit guarantees and the Climate Investor One tranched fund structure. It also makes a case for new guarantee facilities to help achieve the scale required, with analysis that suggests mobilization rates of 30 times are possible. We welcome evidence of growing ambition to scale instruments. The European Fund for Sustainable Development Plus, for example, has a guarantee capacity of $40 billion to be deployed between 2022 and 2027 for SDG-related investments, $6 billion of which has already been approved. Through the Room to Run sovereign guarantees, the British government will guarantee up to $1.6 billion of existing AFDB loans across a portfolio of 11 countries. The PIDG has demonstrated how guarantees can be used to mobilise local finance in Nigeria, Pakistan and Kenya. Recommendations for DFIs and MDBs. Smarter collaboration for impact. Increased support for domestic collaboration. There is a clear need for greater collaboration between DFIs and MDBs within countries and across regions. However, we believe that priority needs to be given to increasing support for collaboration with domestic players. Specifically to, number 1, domestic pension funds, DPFs. Pension funds in several EMDEs are already large and are growing fast. Across Africa, the value of institutional assets are estimated to be $1.4 trillion. For example, Nigerian pension fund industry assets alone are valued at over $32 billion and grew by over 11% between 2021 and 2022. Domestic pension funds invest in local currency, but largely in national treasury bonds. There is a clear opportunity for them to engage with supporting the real economy in their countries and to diversify into alternative assets, not least because we are seeing some leadership, for example in South Africa, in loosening asset allocation limits. Public development banks, or PDBs, 450 PDBs around the world manage over $11 trillion worth of assets, and with deep knowledge of local markets must be seen as increasingly valuable partners to support private capital mobilization. Finance in Common, FIC, has a key role to play in networking with these institutions. The Paris Summit Roadmap includes an undertaking for FIC to create a compilation of commitments and proposals to enhance PDP's access to de-risking capital for the next G20 meeting. Domestic recommendation for domestic impact fund manager ecosystem is that higher priority should be given to investing in the development of resilient domestic impact fund managers who understand local needs and can invest in early stage companies with the potential to create jobs and positive SDG impacts. We have a growing list of examples across the world of wholesalers that have the potential to build domestic impact markets. ITF Steerco members played a critical role in the development of Big Society Capital in the UK, which alongside the Access Foundation for Social Investment has helped grow the domestic social investment market to be worth over £9 billion sterling. Members of the GSG network have been instrumental in developing similar propositions in Japan, Korea, Portugal, Spain, Canada, Turkey, Nigeria and Ghana. Deploying capital to SMEs is a shared agenda. In many EMDEs, the critical issue is access to affordable finance for creating SMEs. According to our knowledge partners, Collaboratives for Frontier Finance, MSMEs create 7 out of 10 formal jobs in EMDEs, making them instrumental to the creation of economic opportunity at large. And just a reminder of, as always, to break down these acronyms, as there's so many of them, that MSMEs is micro to small medium enterprises. So SMEs as well as what are termed micro enterprises. Within its input paper to this update report, the GSG has produced a valuable analysis of the challenges underlying the problem of access to finance and the landscape of existing tools and responses. We argue that the challenge needs a more ambitious and coordinated approach which fits with the growing priority that both the G7 and the G20 attach to enhancing the business environment and strengthening a partnership with African countries, including through the G20 Compact with Africa. Failure to solve this issue will have serious cross-border economic and political consequences. We observe too big a gap between institutional capital providers and local capital providers who can deploy capital to SMEs. Blueprints for investable solutions may be required to bridge this gap, but they would need to be based on DFI's and PDB's pooled insight to success factors. A number of GSG NABs, National Advisory Boards, are structuring vehicles to channel impact investment to local SMEs, for example in Nigeria, Zambia and Ghana, and more support is needed to design, accelerate and disseminate locally grown solutions. B. This is recommendation B. A better shared understanding of what works. Recommendation 1. Smarter deployment of limited, catalytic and concessional finance. We have joined others in calling for an increase in the supply of catalytic and concessional capital. We have emphasised that now is the time to look beyond public sector balance sheets for sources of more flexible capital and de-risking tools. However, we also feel that this is an opportune moment to take stock of what we have learned over decades to make sure that future allocation of resources is as impactful as possible. There is clear scope to develop a better shared understanding of what works in terms of using catalytic and concessional finance on a broad spectrum to adjust risk profiles and thereby mobilise private capital at scale into high impact areas. The limited number of players who are able to supply catalytic and concessional finance could streamline their coordination within governments and regions, making it easier for governments, project developers and investors to navigate this offer landscape. 2. Pipeline development. Institutional investors continue to cite the lack of quality pipeline as a barrier to investment. Institutional investors require improved access to pipeline with the right fund economics and scale in a variety of impact-related domains, including access to fund managers investing in SMEs, targeted climate or gender lens-focused funds, sustainable infrastructure and affordable housing funds, health, education, agriculture and other SDG-aligned investment opportunities. To overcome some of these pipeline-related issues, some institutional investors have banded together to create asset owner alliances or pooled pension collaboratives. As our knowledge partner CFF argues in their input paper, DFIs can provide greater exposure to investment pipeline by approaching pension funds to co-invest in their deals. DFIs can also better support project development by increasing their coordination with catalytic capital providers, including charitable foundations and impact investors. It is time to learn from what works and allocate finance resources to scale existing assets that deliver good results, following the examples of the PIDG, Global Infrastructure Facility, FSDAI, CFF's Early Stage Local Capital Provider Network and Partnerships for Forests. It is striking, for example, how successful PIDG has been in leveraging $5.3 billion worth of investment in over 200 projects developing sustainable infrastructure in low-income countries to mobilise an additional $24.5 billion. Recommendation C is supporting opportunities to mobile institutional investment at scale. And one is GSSS bonds or outcome-based financing instruments. The GSSS bond market has grown and is now worth almost $4 trillion. It is part of a growing family of investments that tie funding to results and reflects a shift to funding outcomes. However, issuance in EMDEs accounts for only 15% of this global market. IFIs can play a catalytic role in supporting wider adoptions of GSSS bonds in EMDEs through anchor investment, first loss subordination positions, or through technical assistance. Multi-asset portfolios, larger DFIs are able to bundle pools of assets, $500 million or more, to either sell or securitize, and this allows them to create new investment products and recycle their balance sheets faster to free up risk capital. Supporting well-targeted collaborative platforms, the DFIs, IFIs have demonstrated their ability to collaborate for impact, not least through the 2x Challenge, what was launched at the 2018 G7 Summit as a bold commitment to inspire DFIs and the private sector to invest more in the world's women. It has exceeded a $15 billion target, and in September 2023, the Japanese presidency of the G7 launched the Impact Investment Initiative for Global Health with the support of G7 partners and a range of institutions. These targeted collaborations encourage investors to agree on frameworks for investment in priority areas and share information on investments to provide demonstration effect. For those who want to learn more about that initiative, it's on page 31 in a box entitled Impact Investing Initiative for Global Health, the III. But in the aim of just getting the most important parts of this report, I'm not going to read through it. I'm going to just keep to the body text. Our proposal: an urgent process to develop a better shared understanding of what works in two key areas. 1. Getting the most out of the catalytic capital that we have. It is time to convene a new safe discussion that takes an honest look at what we have learned from years of testing the most effective deployment of catalytic capital, including but not limited to concessional finance. While it is easy to criticise DFIs, we should also recognise instances of bold leadership, such as that displayed by the British government when it backed BII, British International Investment, with $1.5 billion of capital to develop their catalyst strategies in 2020. Despite opportunities to learn from one another, this does not seem to be happening in a meaningful way. We suggest promoting dialogue that brings together a range of actors to facilitate mutual understanding. While DFIs are a core part of this dialogue, other sources of more flexible and risk-tolerant capital, such as the Catalytic Capital Consortium and the Global Energy Alliance for People and Planet, should also be included. With new dialogues starting to take place between different stakeholders and institutions from EMDEs, including heads of state, ministries of finance and central banks, pension funds, national development banks, and local capital providers, this is the time to work together to scale proven strategies and co-create solutions. We believe the greatest value will come from surfacing actionable pathways and blueprints for new types of investment vehicles that can drive capitals to the SDGs at scale in EMDEs. Proposal 2, providing small job creators with much needed growth. Alongside this broader dialogue is a significant opportunity to develop a better shared understanding of what has worked and what has not worked in a specific area of high importance. In this report, we have stressed the importance of making it easier for SMEs and domestic fund managers to access finance, especially by connecting the big institutional capital, international and domestic, to local asset managers working with small and growing high-impact companies. This is applicable to all economies as it involves creating valuable jobs, but is especially relevant for EMDEs. We would take it further by stressing the importance of the S in SME, that's small. Over the years, a handful of different typologies have been used to try to get the right kind of capital to small companies, ranging from directed loans taking ownerships in local banks, microfinance, funds of funds, fintech, and trade finance. However, a substantive stocktake of our learning from previous typologies has not taken place. In the context of EMDEs, a subset of DFIs should be provided with the resources necessary to collaborate with each other and with dialogue partners to conduct portfolio analysis that foster a deeper shared understanding of effective strategies. This will enable the most impactful allocation of finite resources in the future. And again, we should be seeking to surface actionable pathways and blueprints aimed at narrowing the gap between institutional capital and small, high-impact businesses. This could carry a significant dividend in the opportunity to mobilize the large, fast-growing capital pools of capital, which we have identified as a priority, particularly because they do not have to hedge currency risk. That was a mistake. I don't have time to fix all these in the recordings. It should have said fast-growing domestic pools of capital. Let me just read that sentence again, in fact. This could carry a significant dividend in the opportunity to mobilise the large, fast-growing domestic pools of capital, which we have identified as a priority, particularly because they do not have to hedge currency risk. Turning this insight into action. Connect the learnings on catalytic capital to the new regional catalytic facilities we propose, and build a coalition of the willing to transform the financing landscapes for SMEs. Given the geopolitical importance of helping job-creating SMEs to grow, we call on the G7 and the G20 to use their convening power to build a diverse coalition of public and private investors to collaborate in mobilising more investment in support of MSMEs in EMDEs, leveraging the learnings and actionable pathways that surface from the dialogues which we propose. As outlined below, there are precedents in the form of the G7-led initiatives to mobilise more investment to empower women and to global health through the Impact Investment Initiative for Global Health. Few organisations are better placed to convene the first broad dialogue than the GSG, who is currently undertaking this endeavour. GSG is also well placed to initiate and contribute to the more specific dialogue around what works in delivering appropriate finance to small companies in EMDEs. However, this project will require more dialogue partners to support the DFIs in assessing the data and convening the full range of actors across the different typologies that have been tested. As partners of 2X and the implementation partner of III, both the ITF and the GSG would be well positioned to support a similar initiative focused on MSMEs. And that brings to a conclusion Chapter 3 of the ITF State of Play 2023 report, which was, of course, focused on capital mobilization for the SDGs in EMDEs, emerging markets and developing economies. Going to be moving next on to Chapter 4, which is a very interesting chapter called Next Frontiers, where they point the way to specifically outcomes partnerships. Really recommend sticking around for that. We're near the end of the report for those who are working through these episodes. And again, just to reiterate my name is Daniel Rosehill. To reiterate that, if you want to get in touch with me, public@danielrosehill.com, 2 L's in Rosehill. And please do consider sending me over more reports to read. These are very, very dense reports. I'm very, very much aware of that fact. That's why I decided that it would be good to replicate them in audio format so that people can digest them perhaps at a more leisurely pace. And feel free to use the playback speed functions on your podcasting app if you find I'm reading too quickly. May be the case. I had a strong cup of coffee before recording this, but I think this is important work in getting these out and more accessible to more people, because this is all massively, massively important stuff. Thanks for listening today, and until the next episode.